Foreclosures are erupting across the United States like a ticking economic explosive that everyone senses but refuses to acknowledge. Behind every sealed front door sits a narrative of layoffs, missed mortgage payments, and families witnessing their lifelong aspirations evaporate within hours. Nearly 1 million homeowners have already fallen behind on their payments, the highest figure seen in more than 10 years. And the structural fractures are widening quickly. Credit card delinquencies have surged back to levels reminiscent of the 2008 financial crisis. Layoff waves are cutting through both the tech sector and manufacturing industries. And the fantasy of a soft landing in the housing market is rapidly collapsing. This is no longer a cautionary forecast. It is the opening chapter of America's next housing catastrophe. Florida's housing market has effectively become the nation's pressure valve, and that valve is beginning to rupture. One foreclosure now strikes for every 267 homes in the state, the highest ratio anywhere in the country. This is not a tale of reckless or irresponsible borrowers. It is a systemic unraveling fueled by unchecked costs and chaotic policy conditions. Home insurance premiums in Florida have soared an astonishing 25% per year since 2020, pushing the average annual cost above $6,000, triple the national median. 7 major insurance companies have withdrawn entirely from the state, and the ones still operating are shifting the burden onto homeowners who are already struggling to pay property taxes that have climbed between 30% and 50% in several counties since 2019. When combined with mandatory condo special assessments introduced after the Surfside collapse, ranging anywhere from $10,000 to $80,000 per unit, Florida's once booming real estate landscape has begun to resemble a mortgage graveyard. The data leaves no room for interpretation. Orlando now records 1 foreclosure for every 234 homes. Jacksonville follows closely with 1 per 241, and Miami reports 1 per 247. In a state previously driven by migration, retirees, and vacation home investors, these numbers reflect a profound shift from growth to mass liquidation. Home values across several coastal zip codes have remained stagnant since the first quarter of 2024, even as insurance premiums and maintenance expenses surged far faster than local wages or rental prices. The average homeowner who purchased a property in 2021 with an ultra-low 3% mortgage rate is now experiencing an effective payment shock approaching 40% once insurance and tax adjustments are included. Even for households without job losses, this financial equation is simply unmanageable for tens of thousands of families. Florida's unraveling is not an isolated failure. It represents the leading edge of a national trend where cost inflation is outpacing income growth by a factor of 5. The state illustrates how an economy can appear robust on paper while its underlying foundation quietly deteriorates. Tourism revenues camouflage household financial strain. Population growth disguises widespread vulnerability. Once the headlines are stripped away, Florida's economic indicators mirror the same pressures building in dozens of other states: rising insurance premiums, steep municipal tax increases, and stagnating incomes creating unbearable stress for middle-class mortgage holders. The illusion of a sunshine-proof market has deceived many analysts into assuming foreclosures remain contained. Yet delinquency pipelines in Florida's largest metro areas have expanded for 8 consecutive quarters. Banks refuse to publicly admit it, but their non-performing loan ratios have already doubled since 2023. This is precisely how a crisis materializes, not through an immediate price collapse, but through silent financial decay. Florida homeowners are exhausting their cash reserves long before their home equity disappears. Once that threshold is crossed, defaults become unavoidable. Every metric, from insurance loss ratios to tax arrears, signals the same trajectory: a systemic breakdown expanding outward from the southeast and spreading north. The next phase of financial stress is emerging from states historically viewed as stable, but now exhibiting undeniable structural deterioration. Alaska, Delaware, and Nevada have become early indicators of a nationwide foreclosure escalation that can no longer be dismissed as isolated volatility. The numbers are severe, and accelerating beyond national averages. Foreclosure filings in Alaska have soared 55% year-over-year. Delaware has witnessed a 49% jump, and Nevada has recorded a 43% rise within the same timeframe. These figures are not merely statistics, they represent the first signs of an expanding credit fracture cutting across multiple layers of the U.S. economy. Alaska's data is particularly revealing. The state's heavy reliance on the energy sector amplifies every economic shock. Oil production has fallen nearly 11% since early 2024, while operating costs associated with exploration and transportation have increased by double-digit percentages due to inflation and weakening global export demand. This imbalance is simultaneously slashing state revenues and constricting employment, pushing mortgage delinquencies up 38% in just 6 months. Median household income has failed to keep pace with inflation-adjusted benchmarks, meaning more Alaskans are defaulting not because of extravagant home purchases, but because their economic foundation is eroding faster than their living costs can be sustained. Delaware presents a different, yet equally perilous, scenario. Although the state is the nation's corporate registration hub, it is now suffering from what economists describe as phantom stability. Major financial, legal, and administrative firms headquartered there depend heavily on revenue generated from external markets. As layoffs ripple across the broader East Coast economy, Delaware's housing sector is absorbing the fallout. The state's foreclosure initiation rate has now climbed to its highest level since 2013. Rising property taxes, up 22% since 2020, and escalating insurance costs have crushed middle-income homeowners. Despite having one of the smallest populations in the United States, Delaware's growth rate in mortgage delinquencies now exceeds that of states 10 times larger, a clear warning that population size offers no defense against systemic fragility. Nevada, once celebrated as a symbol of post-recession recovery, is flashing red once again. Las Vegas housing listings have surged 34% year-over-year. Inventory is expanding at twice the pace of demand, while household debt-to-income ratios have now surpassed levels seen before the 2008 crash. The casino and hospitality sectors, core pillars of Nevada's labor market, have recorded revenue declines for 3 consecutive quarters. This contraction is destabilizing wages for hundreds of thousands of workers dependent on fluctuating hourly employment. Paired with mortgage rates hovering near 6.4%, payment-to-income pressures have crossed into unsustainable territory. These states are not anomalies. They are harbingers. Yet the most alarming new pressure point originates from America's white-collar employment class. The technology sector, once viewed as the safest and most lucrative segment of the modern economy, has become the primary generator of new mortgage delinquencies. Between January and September 2025, massive layoffs swept across major tech firms. Intel eliminated 24,000 positions. Microsoft cut 15,000. Amazon reduced its workforce by 14,000. And Meta laid off 3,600 employees. These job losses directly affect high-income homeowners carrying mortgage payments between $3,200 and $5,800 per month on properties purchased during the ultra-low interest rate era of 2020-2021. Federal Reserve data now indicates that mortgage delinquencies among borrowers earning more than $150,000 annually have increased 42% year-over-year. In California's Santa Clara County alone, more than 9,000 mortgage holders entered early-stage default during the second quarter of 2022, the highest figure recorded since 2011. Washington state's King County reported a 37% surge in 90-day delinquencies within the same period. These numbers confirm a clear structural linkage between high-income job loss and accelerating mortgage instability. When salaries above $200,000 disappear, financial reserves are drained quickly because fixed expenses, mortgage payments, car loans, insurance premiums, childcare, and general living costs consume an average of 67% of total household income. Another critical shift reshaping the crisis is the collapse of the equity-based compensation system. Stock options and performance bonuses, once used as leverage for mortgage qualification and refinancing, have lost substantial value as the Nasdaq has fallen nearly 19% year-to-date. As share prices decline, the collateral that previously supported home equity lines evaporates. With that collateral gone, homeowners lose the ability to refinance, effectively trapping them in 6.4% mortgages even as their incomes deteriorate. Internal banking assessments now reveal that 58% of jumbo loan borrowers are classified as payment-stressed, a category that remained below 20% before the current wave of layoffs began. The nationwide impact is immediate and severe. High-income households now account for 11% of all foreclosure filings, compared with just 4% in 2022. Unlike the subprime wave of 2008, these new defaults are concentrated among borrowers with significant leverage, families carrying 2 mortgages, private school tuition obligations, and property tax burdens exceeding $18,000 per year in counties such as Santa Clara, Travis, and King. Once savings accounts and vested stock equity are exhausted, the slide into foreclosure unfolds faster than in any previous housing cycle. And this unraveling is not restricted to traditional tech hubs. The ripple effects are expanding through adjacent industries sustained by technology demand, marketing, consulting, logistics, and commercial construction, where an additional 95,000 jobs quietly disappeared in 2025. As upper-tier earners default on mortgages, consumer spending contracts, and housing demand weakens across entire metropolitan regions. This marks the next stage of economic deterioration. An affordability crisis no longer driven by soaring prices, but by collapsing liquidity and evaporating credit confidence. The subsequent chapter of this crisis illustrates how household debt, inflation, and stagnant wages are converging into a single, unsustainable formula that now defines the American economy. The erosion of high-income job stability has bled directly into the consumer credit ecosystem, revealing how fragile the broader financial structure truly is. As mortgage delinquencies spread through professional sectors, household debt has surged to levels no income tier can reasonably sustain. By the third quarter of 2025, total U.S. household debt surpassed $18.2 trillion, the largest quarterly increase ever recorded. Mortgage balances alone have climbed to $12.4 trillion, but the real pressure lies within revolving credit. Credit card balances have reached $1.25 trillion, and for the first time since 2008, more than 7.3% of these balances are over 90 days delinquent. The consequences are enormous. With average credit card APRs hovering around 22.4%, Americans are paying nearly $280 billion annually in interest, money that no longer cycles back into the consumer economy. Although official inflation reports cite 2.8%, essential categories tell a harsher story. Electricity prices up 9% year-over-year, auto insurance premiums up 16%, and property taxes in major metros, including Clark County, Nevada, and Travis County, Texas, rising between 18% and 27% since 2020. Meanwhile, wages have grown only 3.1% during the same period. This imbalance explains why the financial system appears stable on the surface while millions quietly fall into distress. Housing affordability metrics reveal how deep the strain truly runs. The median U.S. home price reached $423,100 in August 2025. At a 6.35% mortgage rate with 10% down, the typical monthly payment is now $2,340, requiring an income of roughly $94,000 just to qualify. Yet the national median household income is $78,800, leaving a structural affordability gap of more than $15,000. This gap explains why first-time buyers now represent just 24% of the market, the lowest share since data collection began in 1981. For younger Americans, the picture is even bleaker. 67% report they cannot afford a down payment, and 49% say they cannot manage projected monthly payments even if they were approved for a mortgage. Household debt ratios have breached traditional recession thresholds. The average household now allocates 45 cents of every dollar to servicing debt, mortgages, auto loans, and credit cards combined. As interest costs rise, disposable income collapses. Once emergency savings run out, delinquencies escalate rapidly. Mortgage servicers in Nevada, Florida, and California are reporting non-payment increases exceeding 31% year-to-date, mirroring the earliest signals of the 2008 collapse. The path is mathematically inevitable. Stagnant wages plus rising costs equal unavoidable defaults. And unlike previous cycles, the system cannot rebalance through refinancing because high-rate mortgages have locked borrowers into long-term obligations they cannot escape. Every dataset, debt ratios, affordability indexes, delinquency curves, confirms that this is no longer a temporary shock. It is a structural breakdown in consumer finance. The consequences are already visible in market liquidity. Home listings have risen 19% nationally, while transaction volume has fallen 14%, signaling that buyers are disappearing faster than sellers can reduce prices. The pressure created by delinquencies and tightening credit has now entered a feedback loop. The housing market is effectively consuming itself. The more banks restrict lending, the faster defaults accelerate. By September 2025, the United States recorded 196,742 new foreclosure filings, an 8.1% increase from the previous quarter. The total unpaid principal on these properties now exceeds $62 billion, enough to wipe out the combined quarterly profits of the country's 10 largest regional banks. Each percentage point increase in foreclosure activity removes roughly $7 billion in collateral from circulation, suffocating local liquidity and further suppressing home sales. Inventory data reinforces the scale of this shift. Active listings nationwide have risen to 1.32 million, compared with 1.08 million a year earlier. Yet pending sales have fallen 15%. Demonstrating that growing supply does not equate to growing demand. The share of homes undergoing price reductions has climbed to 38.4%, the highest level since 2012. In previously red-hot markets, including Las Vegas, Tampa, Phoenix, and Charlotte, median home prices have fallen between $27,000 and $41,000 since January. Across the country, average homeowner equity has dropped by $18,700 in just 6 months, erasing $1.9 trillion from total household net worth. Mortgage servicers are quietly absorbing the shock through expanded non-performing loan reserves. The 5 largest banks collectively increased their NPL provisions by $10.6 billion since Q1, signaling that industry leaders acknowledge these defaults are not temporary anomalies. Loss recovery ratios have deteriorated sharply, from 87% in 2022 to 74% in 2025, because falling home values prevent lenders from reclaiming full balances through resale. In effect, the financial system is recycling bad debt at a discount, each transaction writing down capital that cannot be replenished through new lending. This environment is reshaping buyer behavior entirely. Cash transactions now represent 33% of all home purchases, up from 23% 2 years ago, illustrating that only liquidity-rich buyers remain active. Individual mortgage-dependent buyers have declined 27% year-over-year, creating a vacuum increasingly filled by corporate investors, REITs, and private equity funds. This migration in ownership structure is not incidental, it is structural. As traditional households lose access to affordable credit, institutional buyers are quietly consolidating dominance over entire neighborhoods at valuations far below their true market worth. What began as isolated distress among over-leveraged homeowners has evolved into a full-scale, systemic deleveraging cycle. Each phase, surging foreclosures, collapsing equity, tightening credit, feeds the next with almost mechanical inevitability. The financial system has transitioned from a correction phase into outright liquidation, where property ownership no longer functions as an economic decision but as a capital-driven event. As the foreclosure wave spreads, the housing landscape is being redrawn by capital that operates without pause. Institutional investors, private equity groups, asset managers, and corporate landlords are acquiring distressed homes at a pace with no historical parallel. During the first 9 months of 2025 alone, roughly 412,000 single-family properties changed hands through bulk acquisitions totaling more than $92.4 billion. Nearly 61% of these transactions were carried out in cash, completely bypassing traditional lending channels. Homes once valued at $340,000 are now being purchased for barely 60 to 70 cents on the dollar, generating instant arbitrage gains, while ordinary homeowners lose equity built over decades. The strategy is simple yet devastating for everyday buyers. As delinquent mortgages convert into REO inventory, institutions buy in bulk before listings ever reach public markets. In certain counties across Texas, Georgia, and Florida, 1 in every 5 home sales now involves an institutional purchaser. Their capital stems from securitized credit pools and yield-seeking funds managing more than $1.3 trillion in total assets. For them, falling prices are not a threat. They are an entry point into permanent ownership. Every $1 billion deployed in this downturn secures roughly 3,800 housing units, meaning the top 10 funds alone could collectively control more than 300,000 homes within 2 years. This concentration of ownership is fundamentally reshaping market mechanics. As institutions accumulate properties, supply appears abundant on paper but disappears from genuine circulation. Rental conversions surge while homeownership rates steadily decline. In 2020, U.S. households owned 65.4% of occupied homes. By mid-2025, that figure has fallen below 62%, marking the steepest drop in 50 years. Median monthly rent for homes converted from foreclosure now averages $2,160, a 14% increase from the previous year. This forms a closed financial loop. The same capital that contributes to foreclosures through debt exposure ultimately profits by leasing those very homes back to families displaced by it. The scale of this transition reveals a structural imbalance that cannot be reversed with simple interest rate shifts or stimulus measures. The mortgage market has split into 2 distinct realities, one where households borrow and fail, and another where institutions purchase and retain. As liquidity consolidates at the top, local economies lose ownership diversity, property tax bases weaken, and affordability metrics deteriorate even further. This is not a market correction. It is an industrial-scale transfer of assets. Comparisons to 2008 overlook the core dynamics of today's crisis. The previous collapse stemmed from reckless lending. The current one is powered by systemic imbalance. In 2008, homeowners owed more than their houses were worth. In 2025, they still possess equity, but it is evaporating faster than liquidity can protect it. Total homeowner equity peaked at $33 trillion in late 2024. By mid-2025, it has plunged to $31.2 trillion, a loss of $1.8 trillion in under 9 months. Meanwhile, the number of underwater mortgages has surged 58%, rising from 1.3 million to 2.1 million properties. The credit environment has fundamentally changed. Adjustable-rate subprime loans, the catalyst of 2008, now account for less than 3% of all mortgages. The danger is no longer credit quality but systemic exposure. Mortgage portfolios are now heavily concentrated in institutional hands, meaning a localized shock no longer stays local. It ripples instantly across securitized financial instruments. Every 1% decline in national home values now wipes out roughly $280 billion in collateralized assets. That loss directly hits pension funds, insurance companies, and mortgage-backed security holders across the globe. Monetary policy offers little protection. The Federal Reserve's September rate cut from 4.25% to 4.0% barely nudged mortgage rates, which remain nearly fixed at 6.3%. Rate reductions no longer produce affordability because capital is locked into high-yield bonds and institutional real estate holdings. At the same time, inflation continues above 2.7%, ensuring that real income growth remains negative. This combination, high debt, stagnant wages, and restricted liquidity, creates a slow-motion contraction rather than the abrupt crash experienced in 2008. Unlike the previous downturn, today's contraction carries significant political consequences. As homeownership falls, wealth concentration intensifies. The top 10% of property holders now possess 44% of all residential real estate value, up from 34% a decade ago. As ownership consolidates, housing shifts from essential shelter to financial inventory, distorting everything from rental rates to neighborhood demographics. The true danger lies in the illusion of stability. Institutions can weather losses. Individuals cannot. That imbalance prevents the market from naturally resetting. Instead of a rapid collapse followed by recovery, the system sinks into stagnation, prices soft enough to erode equity yet high enough to block new entrants. By late 2025, surface conditions still appear deceptively calm. Home values fluctuate within narrow ranges. Unemployment remains below 5%. Official inflation metrics suggest moderation. Yet beneath those statistics, liquidity, credit, and consumer confidence are deteriorating simultaneously. Pending foreclosures awaiting court approval have climbed above 540,000 properties, representing more than $126 billion in distressed debt set to flood the market in early 2026. Banks are slowing final repossessions to avoid triggering massive valuation write-downs that would destabilize quarterly financial reports. This artificial stability is dangerous because it conceals acceleration. Rental vacancies are rising even as rents stay elevated. Housing supply is increasing even as affordability deteriorates. It is the mathematics of systemic distortion. A market operating at half its normal transactional velocity cannot self-correct. Current absorption rates reveal that only 67% of listed homes will sell within 90 days, down from 91% just 2 years earlier. That 24-point decline represents roughly 460,000 unsold properties, inventory piling up like tectonic pressure beneath the surface. Monetary buffers are nearly depleted. Federal and state assistance programs have exhausted more than $48 billion in homeowner relief since 2022, while delinquency support funds have fallen to under $3.2 billion nationwide. Meanwhile, consumer savings have dropped to $740 billion, the lowest level since 2013, while revolving credit continues setting new records. These conditions guarantee that any additional shock, a contraction in employment, an insurance collapse, or a credit market freeze, will push the system beyond its balance point. What follows will not resemble a traditional crash. It will resemble an economic landslide, slow, uneven, and unavoidable. Once the process begins, home values may fall only 10 to 15%. But the wealth effect could erase $4 trillion in household equity and suppress housing demand for years. Institutional buyers will endure. Middle-class homeowners will not. The illusion of a soft landing will evaporate the moment delayed foreclosures enter the market simultaneously. The silence of apparent stability is the loudest warning. Every indicator, delinquencies, equity erosion, transactional decay, points in one direction. The U.S. housing market is no longer cooling. It is deteriorating in slow motion. The storm has already formed. The only element missing is the moment of impact. When it arrives, it will not resemble 2008. It will resemble a permanent redefinition of who owns America itself.